How many of you want to make a career transition but feel that you are stuck where you are because of prior financial commitments? So those who had clicked previously, you can just lower your hand. And then if this new statement applies to you, if you can just click on the blue hand. All right, so just one. So you're thinking of making a career transition, but maybe you feel that you don't have a lot of options and you're stuck because you have prior financial commitments. So the rest of you, I don't know what other categories I haven't covered. So you are kind of happy staying where you are. You're not really actively looking for transition right now. Maybe that's the last category. Kai, okay. Who else? What? Okay, if you are in other categories that I haven't touched on, maybe you can just type in the chat. So this will just help us to keep in mind what are some of the situations that the audience that you find yourselves in as we go through the rest of the webinar today as well. All right, so for the purposes of today, we just want to look at whether it is true indeed making career transitions jeopardizes my financial independence plans. Number one, if that is true or not. And if it is true, what are some of the adjustments and different things that I need to do so that I can make sure that I do not compromise my financial independence point. So with that, maybe I can pass over to Kai to take us into the session from here. Just let me know whenever you want me to bring up any of the slides.
All right, awesome. Welcome back, guys. For those who were here earlier on, did you bring your pen and paper? For those who are here newly, I suppose, right? Can you, if you can grab hold of a piece of paper and a pen, that will be really useful, because I think we want to do some really basic but some hands-on drawing at what would financial independence be looking like, and just some very basic math on what it looks like. I hope that will be a useful thing. So for those who are already very savvy in putting together these numbers, please bear with I think a good number of people who are actually just quite new to a good number of these terminologies and terms. Yeah, so yeah. Can you raise your hand? Is it? Can you raise your hand if you are ready with your pen and paper or whatnot? Okay.
Anyone does not know where the blue hand is, if you can just unmute yourself and say so.
I found the blue hand.
Yeah, so just click on participant, okay, and then something should pop up, and then you should be able to see blue hand, and you raise hand, and then you can just click on it.
Okay, awesome. Yeah.
All right, awesome. I think most of us have it. Thank you.
Can I proceed, or is there anyone who really wants to follow us along by scrambling to find your pen and paper? We can wait for you for a minute or two.
Just unmute and say some.
Yeah. 5, 4, 3, 2, 1. All right, let's get going. Yeah. So I think it's really interesting with this in this context of 100-year life, right? I think being financially independent becomes a more and more relevant, I think, topic also at the same time where we are in the midst of this COVID and the recession that could come along with it. And so I thought, hey, we will begin with our first poll, okay? And no poll.
I already did that just now when I asked people to raise hands. Oh,
the poll. Yeah, we had the poll, right?
Oh, okay, sorry. Okay, yes, I got it. Yeah.
So we begin with the first poll, okay, in just putting some context to our financial independence, and yeah. So feel free to click 1 or 2 or 3 or 4 or 5 or as many as you want to, okay? And not exhaustive, right? And you have other things that is important in the financial independence plan, please take others and then tell us a bit about it, yeah? If you want to. If not, then of course just put it down in your piece of paper, you know? We're just going to give a little bit more time for some of these things and some of these questions that we're asking, hopefully to just give you some room to catch up or to just be on it, you know. So I think it'll be helpful if those that are really quick in doing it, you can just type like done. I think you can type done in the chat so that we know where we are, and we move with, I think, majority of where the group is at.
Yeah.
Right?
I see that no one has actually done any clicking yet. Just wondering if there's an issue for anyone.
I have
Oh, it's not refreshing. I don't know why.
okay. I have already finished clicking.
Oh, okay.
I
Right, it's
see
not-
it.
You see it, is it?
Yeah.
Oh, okay. So are we nearly done?
Yes, we have everyone. Okay, the last one entered our launch poll.
All right, great.
Okay, awesome. Oh. Okay. This is very typical Singaporean. A house fully paid for is always number one. Yeah. Oh, travel, spending, a car. Okay. Okay, awesome. Can we bring up the first slide on
What is financial independence?
Yeah. At any point in time, if any of you have any just like key questions that you want me to help to address a bit more, then you can just type it in the chat. Okay. Yeah. If not, then I'll just keep going with the majority of the group. Yeah. This moment. Yeah. Okay. So I think to just simplify things to the baseline of it, right? Financial independence can mean different things to different people, right? But I think the context of it is that at the end of the day, in general, right, we probably all need a roof over our head, which is what everybody has clicked. So I think that's done, right? And then we are trying to figure out, hey, what is this X dollar that I will need to be able to generate an income to sustain my desired lifestyle? Yes? Yeah? Those who agree, put up your what? Blue hand, is it? Okay, sorry, lower hand first. Okay. Yeah. Yeah, so okay, so we are going to put an X dollar to it. Okay, now I want you all to help yourself with something, right? So for those who have ticked all those different columns, right? Okay, now I want you to translate, right, and put a monetary value, right? Okay, on those dollar terms, right, to those objectives that you have ticked off. Okay, don't worry about X dollar one first. The one I will cover later on. Okay, but for all the other objective, right, put down an equivalent dollar amount of sort, right?
Can I check whether it will be a monthly amount?
Lump sum, capital sum. Yeah? Let's say, for example, a cafe, to set up a cafe, you probably are talking about $250,000 for a simple cafe, you know. Yeah. A car in Singapore, I guess what is the most common cars in Singapore are the Toyota Altis, Toyota Corolla Altis, Honda Civic, and I think Mazda 3, and that costs about $100,000 for a 10 years COE. Yeah. So depends also on what is the age that you are financially independent. If you are 60, financially independent, and it's a 100-year life, then you need 4 times that. So that's 400K. Yeah. But just ballpark, don't worry about the exact numbers, okay? We're just putting a little ballpark to it, okay? Which later, after you've done these numbers, right, you just add on to your X dollar plus this number. Okay, so basically your X dollar got bigger, right, with these additional things, because it has to be going beyond sustaining just your lifestyle, okay? Yeah. So far, so good. Are you following? Yes, you can type yes if you are yes following. Okay, awesome. Okay, one yes represents all yeses. Okay, I'm going to continue, right? Yeah. So I think there's just 2 points I want to make on this. What is a capital fund, right? Okay, so in financial terms, there's 2 analyses that we do when we talk about having to determine how do we find out what is X dollar. Okay, one is called the financial need analysis, right? The other is called a capital need analysis. Okay, what's the difference? Very simply, financial need analysis is about I bring out a certain amount of money, right? I hit that point, right? And then there's a certain amount of years that I think I will have to draw it down on, then it goes down to 0. So example, let's say I need $1 million at 60-year-old, right? I expect to live up to say 80 years old, right? My $1 million will draw down to 0 at 80 years old. So that's financial need analysis, right? Capital need analysis, right, is to be able to build up this X dollar capital fund, right, that can perpetually generate you an income to sustain your lifestyle so that you don't draw down on it. Yeah. So I think the usefulness of that is that now thinking in the context of a 100-year life, right, outliving our resources is becoming more and more, I think, of a concern. And I think financial need analysis probably works in the past, but it's less relevant today. Yeah, of course. So I think the goal, the gold medal aim is to really be able to hit the financial independence using capital need analysis, right? But barring which with other situations, then financial analysis is the baseline that you cannot go below. Otherwise, you would not be financially independent. Okay, so what is the next slide? Yeah. Okay. Can we have a ballpark? Can we poll what is the X dollar for most of our people, just to give me some context to be able to take it further? Yeah. Ballpark. So I mean, if we say we calculate 3,000. Okay.
Sorry, Kai, can I just check, is this slide that you want, calculating X?
No, it's okay. I mean, just trying to have a ballpark of, okay, so sorry, my question is your X plus whatever capital sum additional, right? What is that additional amount? I just want to have an idea.
Sorry, Kai, can I clarify what is capital?
Capital
Fund.
fund is X dollar. Yeah, that's actually capital fund.
Sorry, so your question is, you're asking us what is our X?
Yeah, kind of. Yeah, just ballpark. I just want to have a ballpark idea. Yeah.
That means like how much we want to have for the car and the house and whatever.
Yeah, so like say for example, if you
Okay.
put up a cafe, you put up a car, right? Then
Yeah.
you have now been able to put a corresponding, I guess, a number to those components.
Mm.
So I just want to know how much beyond X that you are that you all have put up to.
So like car is 100, then
Yeah.
house is, I don't know, 200.
200?
I don't know how much is house.
200 in Malaysia, yes.
So how much is house?
Yeah, I don't know. I mean, I suppose it depends on whether or not you are buying it together with somebody or just individually. But I think something like 300K
Okay.
probably is
Okay, so about, say, okay, somebody replied already, 500K.
Okay. I mean, just want to have an idea. Okay, so that's not, don't worry, that's not critical. I think some things, okay, in the process of us going through it, some questions, I think some you might find a bit lost, but I think it should piece together eventually, somehow. Okay, right? Okay, good. I just want to know that you all are on it. Yeah. So okay, the next concept I want to just be able to share is this thing about joyful allocation. Okay, so this works for most people who are employed. Okay. By another corporation or somehow, right? So this allocation is not applicable directly to those who are self-employed. For self-employed, we just need to play around a bit with the numbers of it. Okay, so your inflow, okay, say for somebody who makes 100K per annum, right? Your total inflow actually is 100% of that, okay, plus 17% of employer contribution, okay, right, at your certain age group. Yeah, where it tapers off after 45, 55, but in general, I'm just going to be sharing a ballpark that applies to most people, right? So you're 25 years old today, right, and you're making 50K per annum, right? Gross, your employer should be contributing additional 17%, okay, into your CPF for you. So actually your total income or total inflow, right, is 117%. So far, so good? Yes, thumbs up. Yes, just let me know we are doing okay. Yeah, okay, awesome, right? Okay, so what is a joyful allocation? So joyful allocation actually is just a matrix of us coming into contact with many client cases, right? And just being able to find an approximate, everybody will be asking what is a good ratio whatsoever. So I think while we cannot tell everybody what is their ratio, but I think we can be able to have a little framework to give some understanding of a framework, you know. So typically, how does the outflow happen, right? So inflow 170%, right? Outflow typically, right? And in order, okay. So I think these things are all in order, okay. Number one, right? We always pay the tax man first, okay, right? That's number one rule, okay, because it will catch up to you eventually, right? So pay taxes first, right? And number two, right, is to save and invest, right? And number three, right, is to pay down a affordable mortgage, right? And then number four, okay, is to use/spend. Yeah. So most outflows fall in these two categories. Okay. So for example, like I would classify parental allowances as a use/spend. Yeah. So I mean, for your, this is just a ballpark lah, okay. Later you can fill in like the specifics of your own one. So for example, if your income is 60K, you can put in 60K, right? Then you can have an idea of how much you are saving and investing and putting into mortgages, or how much you are using. Okay, yeah. right? This framework of percentage is just to give you a little guidance of sort, okay? Yeah. Yep, you are right that outflow also adds 170%. Okay, this is just to simplify it, okay? Because actually most people in your first 10, 15 years of income earning journey, you seldom pay 7% tax. Yeah. Probably lesser. Yeah. Okay, are we ready to move on next? Alyssa, yes. Yeah.
And just press the thumbs up or type chat. I'll type yes in the chat. Okay, see thumbs up,
I
thumbs
think
up.
if I see 3 or 5 yeses, I'm just going to continue, right? Awesome, awesome. Yeah. Yeah, I'll just run through it. Then later, I think we have a couple of questions. We can take them. Okay. If not, then we'll probably have no time for the question, right? Yeah. Okay. So then how do we get to X dollar, right? Yeah. So we have to make some certain assumptions. Okay. X dollar basically is the total capital fund, okay, that somebody would need. Okay. And assuming that this capital fund, right, can generate a return of 4% per annum, right? This helps you to calculate actually what is the total X dollar that you will need, which is roughly about 10 times your annual income. Okay, so example, right? If the income that we start off with, the example was 60K, okay, right? 10 times of 60K, right, is 600K, right? And that generates annual returns of 24% at 4%, right? Which pays off 40%, okay, that you have allocated towards your using and spending. If you go one slide back, yeah. So when we are financially independent, what happens is that we don't pay any more taxes because we don't draw a further income anymore, right? We no longer draw an income, so we don't save and invest anymore, right? And the assumption also is that our mortgage would have been paid up already. Okay. So when we are financially independent, right, what is left, right, is just us having to be able to fuel and fund for the use/spend. Okay. And if in this example, if you're using 40% as an example, right? So okay, this is just based loosely around a real case study, okay, right? Can I say it's you, Yok? Yeah.
I guess now everyone knows.
So this is based on a real case study of Yok when she was 25 years old and drawing an income of 60K per annum, right? Yeah. So this would be how it reflects out. Yeah.
So Kai, can I clarify that I would have added this X 600K plus like if I had chosen car in the poll just now, if I had chosen like travel, whatever it is, then I would add, say that 400K to the 600K?
Yes, if it has not been budgeted in your use and spend percentage, then it's in addition. Yeah.
Okay, got it.
Yeah.
So now everyone needs to calculate their X lah, then
Yeah,
plus whatever they had just now.
Yeah.
Okay.
Yeah. So get to your X. Yeah. Just quickly get to your X and yeah. Or if for simplicity's sake, you know, if you just want to use X as a 10 times of your current annual income, that's also perfectly fine. I think, yeah. So not to complicate things further. Yeah. So you just calculate your X to be 10 times your annual income, right? Then we can move on to the next slide, I suppose.
Okay.
Sorry, Kai, can I just ask, so what is X? Like if you define X in English, what is it?
10 times annual income.
I know, but like what are we looking? No, what is capital? like we are looking at it
X
as what?
So I think if we go back to the very early first definition, right?
Yes.
Basically, we need to get to we need to have a certain sum of money, right? Right, that can basically be able to generate some income for us. Think of X like your new when you're financially independent, okay, right? You need a new employer, okay? This sum of money is your new employer, right? Who's going to perpetually be paying you, okay, a certain sum of money to sustain our lifestyle.
Okay, so X is an amount of money that we need that we need in order to generate the income.
That's right, absolutely. Yeah.
Okay, so we take annual income times 10 plus whatever we had just now, the car and whatever.
Yeah. But I mean, okay, just to simplify, I think just forget about the additional parts of it. If you, okay, let's just work with
But what if you are
income.
what if you are self-employed? Then you don't have a monthly income
You will still have a monthly income. It will just not be as
as
Stable.
neat.
flat as neat, you know. Yeah. So you probably
Got
have
it.
you have an annual income, right? Yeah.
I see. Okay. Thank you.
Roy is asking whether it's the same as passive income. Is it the same?
I passive. I suppose like, because if you are I mean, it depends on who is managing this X dollar, right? If you're managing yourself, then it's not exactly passive, you know. And if you are outsourcing it and somebody's managing for you and you're just collecting this 4% returns on your X dollar, then I guess it's it's kind of a similar concept as a passive income. Yeah. How many people am I losing? I hope less than those who are still following, right? Yeah.
Then sorry, Kai. Then how do you generate annual return of 24K?
That's making an assumption that if this X dollar, I can put it to work in a portfolio of whether it's certain
Yes.
investment instruments, I can get a 4% returns on it.
Oh, so your annual returns will fund your monthly spending.
Absolutely, yes. That's the point.
Oh,
You know, right? Because,
okay, 明白了.
so that we don't draw down on it perpetually and then it comes to nothing, right? We could outlive our resources. So the good goal to have is to be able to reach a certain sort of money, right? That the returns is what we draw upon to sustain our lifestyle rather than to draw down on this capital fund that we have saved up. Yeah. So that's really ideal financial independence model, you know. Of course, then what if people ask, right? What if I can get 4%? If I get 2%, yeah, then it's just 2% of whatever. Then you need to double your X dollar, you know what I'm saying? If you're getting 8%, maybe you need half the X dollar. Yeah. So actually, it's just a function of 4%. I think is a conservatively decent return that we can expect from investing in today's markets. Yeah. Can we move to the next slide? So Yok has a comment on this: funds our lifestyle in perpetuity even if you live to 120. Yeah, if you live to 1,200, I think also can. Yeah. So I think the goal is not so much to live to 120 or 1,200 years old, right? But the goal is to have a good certainty that we don't outlive our resources. Yeah, because I think the world is really fast changing, and what we have seen over the past even just 5-10 years, it's a very different landscape that I would expect when I first graduated almost 20 years ago. Yeah. So I think dealing with this uncertainty, the best is to have a little bit slightly higher safety net. Yeah. If you don't know who to leave it to at some point in time, you know, just drop me a call. I'll give you my contact number, and yeah, happy to receive that capital fund. Yeah, if I'm still alive. Yeah. One slide back.
Yeah, sorry. Cheryl has a question.
Oh, where? What? Where? I don't see the question.
Oh, sorry. I think it was raised hand that was left over from just now. Sorry.
Okay. Yeah.
Which is the next slide? This one.
Yes.
Yeah. Okay.
Right. So what is the context of this whole putting together that from the joyful allocation to your X dollar, right, to now this number of years thing? I think we are the wrong slide. Yeah. Right. Yeah. So how long to get there, right? Later I'm going to map this, okay, against the framework that we spoke about early on in the 2 o'clock session, okay? Yeah. So I'm going to draw it out for you, okay? So this formula is like that, right? So X dollar basically is a function of how much percentage of the income that you have saved, multiply the number of years you save them, okay? So supposing the example that we give is that for at 25 years old, right, Yok Ling in government service is making 60K per annum, right? And her X dollar is calculated at 10 times the annual income, which is $600,000, right? And using just the example earlier on, she was saving 50% of her income, right? So 50% of 60K is 30K, right? So to get 600K, she will need to save for 20 years, right, to achieve a goal of financial independence. Okay, yeah. Can you see my?
I'm going to stop share and I will spotlight your video so they can see better, okay?
Okay, sure. Yeah. Is it? Can you see this? Okay. Can you see my curry chicken framework?
Yes.
Kind of, right? Okay. So I think by now you should have gotten some baseline numbers that are across the few things, right? And so in the curry chicken framework, right, what happens is that this is a real situation of a pre and post transition, right? So at 25 years old, making 60K of income per annum, and given her current saving and spending habits, right, she needed to be able to find X dollar that basically can give her a perpetual income. Okay. Okay, right, to be able to get at 4% ROI, right, to be able to perpetually generate an income of 24K per annum for her. All right, yeah. Right. And she has funded that, right, using, because from 25 to 45 in her career, right, she would just be funding 30K per annum of saving and investment, right, for 20 years. And that's how she gets to a financial independence at 45 years old. So far, so good? Yes? No? Question mark? So the first 3 points if you recall the earlier curry chicken framework, right? First point is about defining, right, the financial objective and basically translating that objective, okay, right, to a certain dollar amount, okay, which is figuring out what is X dollar, okay, to your situation. That's what we have done, right? Right, and then the point 2 is about the time horizon, okay, which is now we can see is 20 years, okay. So actually, initially at 25 years old, right, Yok's goal actually was to be happily financially independent at the age of 60 years old. Yeah. So her initial goal was to be financially independent at 60 years old, okay, but from just her base calculation of how her current spending and saving habits are, right, we tabulated that she can actually be able to be financially independent, okay, right, at way earlier at 45 years old, right? So the third factor that we use to calculate the income and savings ability is classified under financial capacity in the curry chicken framework.
So here my financial capacity at that time is the generation of income of 60K per annum, is it?
Okay, so there's 2 parts of it. One is that, I mean, if you start off with 0 other additional savings, then there's no current assets. So your financial capacity is made of current assets plus future assets, right? Current assets is defined as, say, today I have 10,000 to start off with, or today I have 500,000 to start off with. That's current assets, right? We are assuming at 25 you came out, you have nothing to start off with, and therefore you are relying only on your future assets, which is your income earning ability, right? And a function of that is actually how much can you put aside, which is your save and invest percentage that forms your future assets. I very far away from 2 million, ha ha ha.
Actually, Clarice, I'll be curious whether you were closer on your previous trajectory. So this one is all like my previous trajectory. Later, we're going to talk about transitions and how that affects the trajectory, which will be the devastating truth. Okay, not say devastating.
Okay. So actually, just back to just now the slide on how many years it takes, right? Yeah. So I want to debunk some myths, right? I mean, like, I don't know, people would hear and come and tell me that, hey, in the Western world, people talk about, hey, if you can you just save 10%, you'll be financially independent. Okay, that's a rubbish in our context because we don't have a social safety net or social welfare or programs like such in Singapore, right? Because if assuming our goal is the third example, assuming our goal is 600K, okay, if we only save 10% of our income per year, okay, guess or calculate or just tell me how many years it will take for us to be able to be financially independent. Yeah. Absolutely, thank you, Roy. 100 years. What is your age now? 22? Right. Suppose if you're in your 20s now, right, then you really have to live to 120 years old, right, to achieve your X dollar, okay, right, which is crazy, right? But supposing if you are saving even just 30% of your income, okay, of 60K, that will be $18,000 per year, okay? If you divide 600K divided by $18,000 per year, actually, right, you will get there at about 33.3 years, you know? So that's not that far off, and every percentage increase actually is going to bring you much closer to the financial independence dollar than you really think it is, you know? Yeah. Okay, are we ready to speak about the transition part? I'm sorry if this is confusing some of you, okay? I mean, I really love to be able to do this, like, I suppose in person and with a little bit more time to explain stuff. But I mean, this is our first time doing this webinar style, so hope to get your understanding on that too. Yeah. Yes, okay. So what happened, right? This is the initial plan and already planned for Yoke at 25 years old, and in the conversation that we had just now, then she was telling me that, hey, maybe I should have just stuck on and stayed till I was 45 and be independent before I made the career transition, But well, I think plans are plans, but I think life got to just move with the plans rather than, plans moving your life. But at least it's just having some framework and benchmark to know how and where to adjust. Okay, yeah. So what has changed, right? What has changed from this plan is that at the young ripe age of 31-year-old, right, Yoke decided that, right, this career, this job is not going to cut it for me to be living a fulfilled life, right? And so, right, she transited from this, okay, right, to a new curry chicken framework 2, okay? Yeah. Which in simplicity looks like that. No more income to save and invest, okay, and no more financial independence, okay, at 45 years old. Okay, sorry, am I scaring off people who are trying to do career transition? Maybe some, right? Okay, but you see what is interesting is that, so at 31-year-old, right, her income dropped all the way down to just figuring out a new career, right, to a small fraction of what she was drawing, right, and therefore, right, her financial independence goal, right, could only restart, okay, right, at a new point in time when then the new career has stabilized, right? So that would easily probably be setting aside just, I don't know, another 5 to 10 years, right, from her initial goal that she could achieve, right? But I think if she could get back on her track within 3 years, right, she should still quite well make it at 60-year-old to be financially independent, I suppose. You know, right? Yeah. So I think the factor that I want to raise up here is that financial objective is one of the first and easiest thing for us actually to be able to adjust. Okay, right? And I think it's about, hey, making a new sense of making peace with this new life that is going to be more fulfilling for you to have, right? And you can adjust that, and that will affect some of the time horizon, right? So these are all factors that's very easy to adjust because it is up to you to decide, right? Yeah. So if today you're saying that, you know, hey, in my income and spending habits wise, I actually only spend 30% of my income, right? Then, wow, I tell you, you're going to be achieving your financial independence earlier than other people because you could probably be saving a lot more, right? If, you know, hey, today you think that in the next 5 to 7 years, it is the right time to do a transition. Okay, 5 to 7 is a bit long, maybe 3 years, right? It's a good time to do a transition, right? And you will be drawing down on some of these your assets that you have saved up to. I would like to say that it's probably fine as long as you have a plan, okay, right? And then you continue to review this plan and this current framework that you have. How much further it's going to derail your independence plan, and will you be at peace with it? You know, right? Yeah. And then, of course, the third factor, which is more difficult to adjust, is the financial capacity factor, right? Because well, if you're self-employed, then you probably have a bit more a greater potential to be able to multiply your income a lot more, right? If you are if you are just being employed, then there's a certain trajectory that you can probably project. I mean, the good news of that is that there's probably some stability to that, but the super upside is probably going to be a bit more challenging in employment than in starting on a business or being a self-employed, you know, right? So that's financial capacity that you can be able to make adjustment of, right? And what if you have made adjustments? That means you have extended your financial independence goal to, okay, 70 years old, you know, that's the max you can accept, right? And you are desiring now not 600K, but only just 400K. You're happy to be able to compromise on your this lifestyle post financial independence, right? And you have also maxed out and worked really hard at whatever your passion is in the sector that you are in, and you know that you cannot save more than what you could be saving already, right? Then we need to then we start looking at factor number 4, okay, which is that then how do we go about increasing and developing your psychological propensity, right, to be able to stretch the dollar much, much, much harder, yeah? So to me, as a baseline, investing really to me is about overcoming inflation, okay? The goal of investing is to overcome inflation, whether is it a core inflation, whether is it certain lifestyle inflation. The aim of investing has always been to just preserve and protect the dollar value, right? Of course, and to grow it, yeah. But for situations where if you have exhausted your framework factor number 1, 2, and 3, right, then for 4, right, we got to really go strategic and be able to have to generate a much higher returns on our whatever capital assets that has been built up to that point in time to be able to achieve your financial independence goal, yeah. Then, of course, with all that, mapping that against, of course, current economic situation, right, again, will become very, very, very useful, right? Because we have seen Citibank, in an example that I give earlier on in the early meetings, right? Citibank could drop to below $1, okay, right? And if you have bought it at $1, right, today, right, if you have put $1,000 there, the $1,000 is worth $44,000 today, okay? So if you put $10,000, that same $1,000, okay, this is just 10, 11 years ago, okay, so it's not a long time ago, right? In these 10 years, right, your $10,000 would have been $440,000, okay, right? And that is the power of the wealth transference, okay, during recession. So don't fret too hard. I think, you know, hey, in the 100-year life journey, and for most of you who are in your 20s or even just 30s, right, there will be many opportunities in the future to adjust that, yeah. So I think developing certain propensity through knowledge, through wisdom, through understanding certain key core principles will ready yourself better for the next recession that you can take advantage of. Yeah. That's
Cool.
all I have.
Maybe I just want to share a bit of a reflection from having done this exercise. I think number one is, at first I was thinking like, yeah, I mean, the options that lay before me actually was continue on that trajectory until I'm 45, achieve financial independence, and then go off and do whatever I wanted to do, right? But I think I also factored in that it'd be harder for me to make a switch at 45, actually. I might be too used to my lifestyle by then and so on and so forth. So I felt like it would actually be harder for me to switch. And actually, if I go back to originally my financial objective, right, I was actually okay with working until 60. And especially now with my new career, my new job, like I feel like I would not mind working until 60 anyways. So yeah, at first I was a bit devastated, but now actually I think I feel better. I mean, if we went back to the point on financial objective, like, yeah.
So I mean, if you have drawn up something in a second time to do it, right? I mean, it's just a good checklist, I suppose, checkpoint check. This is not the holy grail, and hey, if it doesn't happen according to this plan, then my life sucks, or kind of stuff. I don't think so. So actually, this is an ongoing plan, and we actually built multiple such framework for multiple different objectives. Okay, that we want one objective. So today we're just simplifying it to just, hey, if you talk about X dollar, this is what it will be like. This is how it affects certain choices and decisions that you make if you are transiting, not transiting, or whatsoever, right? And actually, at the baseline of it, I think the core principle is that what you can be able to make as an income and what you can put aside, okay, is going to determine a large bulk, right, of the wealth that you have at the end of the day, which will affect your choice of when you can be financially independent, right? And that is the most dependable and powerful choice to make. Yeah. So while I keep on raising the example of the Citibank one, that is just one quite extreme case, because most people would not have dared to buy at $1, right? Yeah. So the bottom was 97 cents, right? And we bought that at 97 cents because we were getting ready to buy. Yeah. So for many years, from 2004, when I first came to the industry, until 2007, 8, 9, we were just waiting for the crash to happen, right? So we've been piling up bullets, piling up capital fund, right? Waiting and anticipating, right, the excitement to be able to buy into these companies that fundamentally has not actually been badly affected, but sentiment-wise, people were just getting very fearful. So everybody was dumping the shares. Everybody was dumping certain things because Lehman collapsed. So a lot of fear, right? So we were buying to the opportunity, and that's how we made some decent money off it. And even then, I didn't throw the bank at it, right? Yeah. So I just put in, like, I didn't buy at a lot. I bought 10K of the company,
Okay,
right.
great. So with that, actually we're at time. So I hope that you managed to calculate like an initial X dollar for yourself, and actually got a chance to practice like the 5 steps of the Curry Chicken framework in terms of looking at the different components that you can adjust if you're thinking of a transition moving forward, kind of pre-calculating at this stage, like what implications that will have for you, and finding new room to adjust, whether it's from step 1 to step 5. All of that offers options and opportunities for you to adjust your plan. So we'll be hanging around another 5 minutes or so for questions. But in the meantime, if you can just scan the QR code before you leave so that you can give us your feedback. This is the first time that we're doing this. So we would like to learn from the experience and see how else we can create more value the next time that we're doing this. And I would also like to share this if you got a good start and you would like to pursue your calculation of X plus, or don't know what, a little bit more, then we are holding these clinics in the following month. So again, please scan the QR code and join us at these clinics for something that's a little bit more in depth than what we were able to cover in these webinars. All right, so with that, we would like to conclude the webinar. We'll be hanging around another 5 minutes or so, but scan the QR codes and give us your feedback, and we'll connect on that. Connect on our socials, which are here. Okay.
I have one question. Can I ask, like, for those of us who are like still studying, like in uni, or like, how can we go about investing? Like, is there any example? Like,
I suppose again, go back to the framework, what objective you want to start off with, right? And then is there a need to invest, or rather you actually just looking to be learning more than to I don't believe in the idea of that you have to put your dollar in to pay for learning lessons, right? I think if the objective is really to be able to learn and understand a bit more, I think there are a good amount of useful resources to be able to read up and to learn and apply. I mean, of course, you can, if you have the gumption to be able to start your investing journey, then yeah, I think there are actually a lot of options available today to just start at very, very low amounts with I suppose certain manageable risks. I haven't really had a full assessment at it. Okay, there are some pretty good options available by some of these robo advisors. If you have came across any of them, okay, I would just qualify that statement to say that I'm not fully convinced yet, because robo advisor started in the US in 2007, 2008, and now 12 years on, right? Even the pioneer companies until today have not made $1 of profit yet. Okay, and to me that is a worrying sign about the sustainability of such companies. But I think for a very, very short term, and so basically they are just being fueled and funded by venture capital monies and liquidity in the market space, but they haven't really found a model that works. And in Singapore context, one of the pioneers in Singapore that started in 2013 has also shut down and closed down, citing unsustainability. And yeah, so but in Singapore, most of these companies, as long as they have a license by MAS, they are responsible to help you find a suitable access or suitable solution, right? Even if they close down. Yeah, so I think the risk is relatively low, just that it may not be the best choice going forward, but they do offer really very low starting point, and for you to be able to get access to these instruments called exchange traded fund, ETF. Yeah. But I suppose, yeah, I mean, I think learning in the community of like-minded people, just using this base framework to ask good questions around to yourself and to people who are introducing anything to you would be a good starting point. Yeah. But of course, if there are more specific details that you want to figure out about and stuff like that, come by for the clinic. We can speak about it.
Oh, okay. Right. I mean, just like generally, like, do you think we should start investing now, or like it's better to wait for like when we have a proper income, then we invest?
Again, I think, well, we go back to your what would be your objective that you want to achieve, you see, right? Is it that you want to start early because you hope to be able to build up an earlier X dollar that you can be financially independent earlier, or it's just really to fund for a very next objective of, say, I am planning to do some small business with, say, I want to set up an e-commerce business with 10K of capital fund. So from today, I want to start saving and investing a bit more of it. Yeah. So again, back down to what is the next immediate objective, right? Because from there, then we can determine what is a good move to make. And I don't think age should be a factor. It's too early or too late, or having income or having no income. That I think are secondary factors. Primary, again, if you can go back to a good, well-defined financial objective that is worth you achieving for, then I think that will probably be a main driver for it. Yeah.
Okay. Thank you so much.
My pleasure.
Hi, Kai. I have a question about the formula. Can you hear me?
Yes. Which formula?
So I just want to check. So basically, like for the example, right, it's like 600K capital fund will generate you 24K per annum. That means you are assuming that whatever we earn at 45 years old, we dump the whole 600K into investment. Is that correct?
Into a portfolio of, into a basket of investment, Say for example, maybe 200K of it could go towards a fixed deposit giving 1%.
Yeah.
Another 200K could go into some perpetual bonds or giving 4.5%. Another 200K is going into say the China stock index. Okay, that's probably doing 7-8%. So you get an average ballpark of about 4%, and that should be the aim, I think, of investing. Because if you are not getting anything like 4 to 5%, then you're better off not investing.
Yeah. So the idea is that this 600K you only get at 45 years old, right? Like in Yoke's example, lah.
Yeah.
So you only invest at 45?
No. So I mean that's just I'm just simplifying it. That means so she started putting aside money at of 30K per annum from 25 years old, right? And this 30K we find suitable instruments basically, but the aim of from 25 to 45, the aim of investing or of putting aside the money into instruments is really to be able to overcome inflation more than to use it, right, for a certain stratospheric returns, you know. It's good if we can have opportunity to be able to make more, we'll make more. But the main aim actually is to be able to safeguard and to be able to put aside the 600K as early as we can. Yeah. Then from there, is the objective will change, right? Yeah. Then we change according to the objective. Yeah.
And based on this formula, the definition of financial independence is basically not working.
Come again?
For this formula that you introduced us,
yeah,
the definition of financial independence, is it not working anymore?
Why?
Because is that what it means? Like, because I keep hearing the term financial independence, but I don't really understand what the term means.
So I mean, I suppose okay. So if in this context of Yoke, right, at 65, at 45 years old, with this 600K that she has banked aside, okay,
Yes.
right, financially she don't have to depend, okay, on an external income, right, to be able to make choices for her lifestyle anymore.
Okay, got it.
Yeah,
okay,
so I think that is what we mean by financial independence, that you have the choice now. She can continue working in her journey, you know. So she can continue working until 60 years old and
of course.
Yeah, but at 45, she can really make a choice. I can sack my employer already, you know what I'm saying? Yeah,
Okay,
so
got it.
a function of financial independence. I can sack wherever I want to sack and go about living my life, you know, my way, kind of.
Okay, thank you. Thanks for clarifying. Then, sorry, can I just want to ask, maybe just one question that's not related to the formula, right? What about cryptocurrency? Like, because it's like a very new thing these days, like, but they are not things, but then we are not trading in cryptocurrency as in the everyday living yet. So is it something that is like, because just now I remember you said like, invest in the things that you use, like consumption, like LV, Prada, whatever.
Yeah.
But crypto we are not really using yet. So I'm just wondering if it's something that is like advisable. Yeah.
Okay, so my school of investing is really very traditional, okay, right? And I think crypto is so when I look at something, right, I look at how do you put a value to something? Okay, so for example, if I look at a company like LV, right? LV is a wonderful company. Okay, price aside, right? As a company wise, if you're a company, right, that you can keep on raising your prices, right, by 5% every year, okay, and more people are buying it, okay, you have a wonderful business model, right? You never go on sale. Every year you can keep on raising prices, okay, and people keep on wanting to have more of it, you know, right? And of course, you assess, you know, hey, what is the likelihood and longevity of such a company, you know, hey, and we are looking at maybe just, hey, are they going to be here in 10, 20 years time? If the answer is yes, then fundamentally they are pretty sound. You know, so we can do some value around this company, right? But with crypto, you know, what is the fundamental value around it? You know, again, I back to the three questions I say I asked myself earlier on about risk, right? Is that okay? Today I buy a crypto. What if my resource? What is my recourse? Okay, right? If Ethereum, okay, right, does not exist anymore.
If what doesn't?
If Bitcoin, yeah.
Or if Bitcoin doesn't exist anymore.
Yeah, right. So if Bitcoin doesn't exist anymore, there's no exchange I can trade the money on anymore. What is my recourse?
Recourse?
Yeah, what can I do? You know? Yeah.
Okay.
It's not governed by any central banks. MAS is not going to cover you because it's not licensed at MAS.
Okay.
If I get a lawyer, who am I going to sue? You know, like I have no recourse, you know. So to me, when there's no recourse, the risks are much broader and wider. Not to say that there's no value in it, because it could form a part of a tactical allocation in the whole portfolio, maybe like 5%. Like, I mean, I buy some gold, you know, I keep some gold. And gold also has got no real value, right? But at least we know that it's a scarcity item kind of thing. So I think these crypto works they're trying to mirror a certain similarity with like gold that is decentralized, something that is finite, will go up in value over time, but not always and all the time, I think. Yeah, so we just need to be allocating the portion, you know. Yeah, and I think more information comes along, we can understand it better. And when it gets regulated a bit more, then I think I will find it safer to be able to look at it with a greater investments. Yeah.
Okay, thank you, Kai.
Okay,
Thank
with
you.
that,
Thanks,
yeah, thank you everyone. So we'll close the room from here. Thank you, and please follow us and continue to keep track on this conversation as it continues. Thank you. Thank you, Samantha. Bye-bye.